Income tax, PPH, is a tax imposed by the government on income or earnings received by individuals or businesses. This tax is one of the main sources of revenue for the government to finance various programs and developments. Below is a comprehensive explanation of income tax, PPH. 1. Definition of income tax, PPH. Income tax, PPH, is a tax imposed on the income received or earned by taxpayers, both individuals and businesses. The tax is levied on various types of income, such as salaries, fees, business profits, interest, dividends, and others. 2. Types of income tax. In Indonesia, income tax consists of several types, including A. Income tax for individuals, PPHOP. PPH for individuals is imposed on income received by an individual or person. The income subject to PPHOP can come from employment, salary, wages, business or freelance work, interest, dividends, and others. Income tax rates for individuals. In Indonesia, the PPHOP uses a progressive tax system, meaning the higher the income, the higher the tax rate. The progressive tax rates for PPHOP in Indonesia are as follows. For 2024. Income up to IDR 60 million, 5%. Income over IDR 60 million up to IDR 250 million, 15%. Income over IDR 250 million up to IDR 500 million, 25%. Income over IDR 500 million, 30%. B. Corporate income tax, PPH Badan. Corporate income tax, PPH Badan, is imposed on businesses or companies for income earned from their business activities. The corporate income tax rate in Indonesia is 22% for the tax year 2024. See Final income tax, PPH Final. Final income tax is a tax imposed at a fixed rate without considering other income. This type of tax applies to certain types of income, such as income from property rental, income from the sale of stocks or bonds, income from certain small businesses. D. Income tax Articles 21, 22, 23, 25, and 26. Article 21 Income tax on income received by employees or workers. Article 22 Income tax collected by another party, such as the government or a company, from income received by taxpayers. Article 23 Income tax on income such as interest, royalties, prizes, and others. Article 25 Income tax paid by individual and business taxpayers based on estimated income for the year. Article 26 Income tax on income received by foreign taxpayers. 3. Taxpayer and tax object. Taxpayer, the party who is subject to the tax, i.e., individuals or entities that earn income. Taxpayers can be individuals, Indonesian or foreign citizens, or businesses, companies. Tax object, the income subject to tax, such as salary, wages, business profits, interest, dividends, and others. 4. Imposition of income tax. Income tax is imposed on income earned during one tax year, calendar year, which is from January 1st to December 31st. The income subject to tax can include income from employment, salary, wages, allowances. Income from business or freelance work, business profits, income from business activities. Income from investments, interest, dividends, royalties. 5. Calculation of income tax. Income tax is calculated by subtracting the allowable expenses, costs, from the total gross income to obtain net income, then multiplying it by the applicable tax rate. Steps for calculating income tax. 1. Determine the total gross income. 2. Subtract allowable expenses, such as operational costs or expenses related to income. 3. The result is the net income. 4. Apply the progressive or flat tax rate depending on the type of taxpayer, individual or business. 5. Calculate the amount of tax owed based on the applicable rates. 6. Income tax payment and reporting. Tax payment. The tax owed must be paid into the state treasury through a designated bank as per the prevailing regulations. Tax reporting. Taxpayers are required to submit an annual